Welcome to another video, and today our topic is can past performance of strategies predict the future performance of strategies? What is the evidence suggesting that past performance will ensure future performance? And This is all we are talking about financial markets and stock markets and futures and options markets and forex markets. Okay, so we're talking about specifically financial markets, not anything else here. And what we are looking at today is, does past performance suggest or predict the future performance of the strategies? And what is the evidence suggesting that past performance will ensure that future performance will be there? Which strategies have evidence that basically makes sure that past performance predicts the future performance, and which asset classes this has happened, which markets this has happened. We want to focus especially examples from UK, US, and India, and we want to see some examples that support this evidence. So if you see this entire thing, that past performance of strategies predicting the future performance of strategies, this is the basic assumption that pretty much all the strategies rely upon. So if you're looking at technical analysis or fundamental analysis or even quant strategies, the basic assumption that they'll make is, they if you look at the quant strategies, they analyze tons and tons of the past data and try to find patterns, anomalies, discrepancies within that data, which are repeated over and over again, and they'll expect that the same patterns will get repeated, or the same anomalies, when they repeated, whatever happened in the past will happen again in the future. Some again, in the quant strategies, mathematics and probability statistics are also widely used, but that also that yeah, probability and statistics have some theoretical framework. uh, but yeah, most of those strategies depend on past data, and based on that past data only, they find some patterns, anomalies, discrepancies, and based on that only they think, or they basically predict the future, that when again this thing happens, this is what will happen. Okay, yeah. Coming to the probability statistics part, that is a theoretical concept, and that is a naturally occurring thing. And yeah, so that has a theoretical mathematical framework. Yeah, even past data supports it or doesn't support it, that will work. Okay, because that's how the universe or the nature, there's a pattern in the universe or a nature. Okay, and that pattern evolves from randomness, so that works. Okay, but yeah, but if you look at even technical analysis, we look at certain everything, basically not only technical analysis, even fundamental analysis, quant analysis, everything, even back testing, when we do in algos, right? We look at the past data only, and we see that this strategy is performing in the past, and then only once it performs in the past only, we'll deploy it in the future. But there is no guarantee that that whatever has performed in the past will perform in the future. But we assume that past, if it's performing, then only it will perform in the future. And that's how we trade. Okay, and even in technical analysis, we find certain patterns, head and shoulders and all these things, and we assume that when again that pattern happens, so this is what is the is going to happen. There's a probability associated with that. Okay, and we also talk about something called as the random walk theory. So random walk theory, what it says is, there is no relationship between the future price movement or stock price movement and the past price movement. It basically says, future stock price movement is totally independent of the past. And what it says is, all this technical analysis, fundamental analysis, and all, even insider trading, and all whatever we are doing, value investing, momentum investing, is all waste. And efficient market theory says, market is very efficient. Don't need any fund managers, and if you just put it in the passive funds like ETFs that will generate more return than any fund manager. That's what it says. So we are basically, challenging that assumption that future is independent of the past and doesn't have any relationship, and we want to see whether really past performance of strategies predict the future performance, and which asset classes does it do it, and which markets does it do it, what are the specific evidence and examples that support this. That's what is our topic for today. Okay, so let's go deeper into it. So, past performance predicting future returns, evidence and theory. So, according to behavioral finance, momentum strategies rely on an idea that winners keep winning. Okay, so that basically says, if you won in the past, you will only win in the future. So, here, momentum strategies, yeah, are an evidence that past performance predicts future performance. And there are some classic academic papers by Jagadish and Titman, which shows that 3 to 12 month returns predict 1% monthly forward returns in US equities. Okay, so that is one thing. And similarly, D Bond and Thaler show medium term winners eventually underperform long term, a mean reversion pattern over 3 to 5 years. Okay, so this is the evidence and theory that past performance, predicts future return. So mean reversion and momentum strategies. These are basically evidence that past performance is the evidence where these strategies are evidence that past performance predicts the future returns. Okay, then we have momentum and time series momentum evidence. So this is again momentum strategies only. So in the US and global markets, US momentum index wins in trailing 12-month winners historically bet the broad market by 9.4%. So momentum index has bet the normal index fund by 9.4% annually. And didn't happen in 1 year. It happened from 1927 to 2023. Okay, but the alpha fell near minus 0.8% in the year in the 2003 to 2023 period due to structural changes in fund flows. Okay, so momentum index has consistently beaten the market, and that too over a long period of time. Trend following or time series momentum across global futures has delivered 15 to 20% annual returns and sharp ratios of 1.5. These trend following strategies are also consistently beaten the market. Okay, but there are some major drawdowns in even momentum strategies, but it regained over long cycles. Like in 73% drawdown is there in 2009, but it regained over long cycles. In India, multiple academic papers show that robust momentum in Indian equities. So Garg and Varshney found momentum was consistent across sectors, especially pharma, auto, and banking. Maheshwari and Dankar, time series momentum with risk management doubled returns versus standard strategies, with which remained significant after risk-adjusted tests also. SK Agrawala, Indian momentum returns averaged 21.9% annum, exceeding benchmarks. Small cap investors using Nifty 200 Momentum 30 indices saw 23.3 CAGR versus 14.6 for the broader indices over 10 years. So momentum strategies are beating the market, and that's the evidence. Um, okay, and the momentum in strategies past performance is indicating the future performance. Okay, then we have value and low volatility strategies. So US and global, the conservative formula, low volatility, consistent earners return 15.1% annually in US equities. And okay, in India also it outperformed BSE 100 by 12.6% per annum. Okay, so value investing strategies and low volatility strategies also outperform the index, and their past performance, can predict the future. Value investing like magic formula. So Greenblatt's magic formula blend of value plus quality delivered annualized returns of 13.9% versus Sensex 9.3. So yeah, so other than momentum, value investing is also beating the market, and its past performance is indicative of the future performance. Okay, reversal and mean reversion. So long horizon reversal phenomena. Past losers outperform past winners over 3 to 5 years after a lag. Like momentum crashes, mean reversion. So mean reversion is also outperforming the standard market, and its past performance can predict the future performance. Okay, so summary is past predictability by strategy and region, cross-sectional momentum, evidence of predictability. 3 to 12 months winners outperform losers by 1% per month. Okay, US and India is example. And again, we have some academic papers, Jagdish, Garg, etc. Time series momentum, trend following across futures, that's evidence. It has also beaten the market. Low volatility value investing has beaten the market. And mean reversal also has beaten the markets. Why these patterns persist is, behavioral biases are there. Overaction, that's where, overreaction of the market, extreme greed or extreme fear. Value investing works because of that behavioral bias. Okay, herding is, momentum strategies work because of herding and fear and greed. Okay, and trends. So that's why these strategies persist. Behavioral biases are there, and that will exist forever in human beings. Slow dissemination of information. Yeah, no one gets, complete information, and even if they get, they can't assimilate that information. So market is not completely efficient, and this causes, less efficiency in the markets and momentum spillage. Structural flows, mutual fund ordering, ratings, media coverage can amplify winners. Okay, basically news or something is, making it move. That structural flows are causing the momentum, and that is causing it to move again further and further up. Mean reversion kicks in after extended over performance. So eventually everything has to revert to the mean. So that kicks in after extended over performance. However, momentum strategies can undergo severe drawdowns during crisis to 2008 crash, environment shifts, tech bubble. So there is a problem with momentum strategies. When the past performance of momentum strategies predicts the future, but we should be wary of, some black swan events where these fail. Momentum strategies do fail. Okay. So momentum and low volatility strategy, and at that time during that crashes and everything, value investing does work. Okay, but it also requires or yeah, a lot of courage and yeah, because catching the bottom is very difficult, right? Yeah, yeah. Momentum and low volatility strategies have shown statistical persistence in India, US, and Europe. That's the final takeaway. In India, momentum delivered up to 22% annualized returns, and it bet the market by 12% per annum. Past performance doesn't guarantee future returns, especially if market environment or capital flows change. And momentum may suffer drawdowns also. But combining strategies like example momentum, volatility, value may provide more robust future performance than relying on a single factor alone. Okay. So there is some evidence that even though the efficient market theory and random walk theory says that there is nothing, no relationship between the future and the past prices, there is behavioral finance and some evidence is there that suggests, that momentum trading and value investing and quant strategies like mean reversion do predict the future, and and they consistently outperform the markets, and their past performance is indicative of the future performance. Okay, that's it for today, guys. Thanks everyone. Have a nice day. Bye.